Ignoring this could cost you more than you think. Did you know that non-compliance with the new FinCEN filing requirements comes with penalties that can reach up to $10,000? And then that's just the beginning. Stay with me as I explain the important things you need to be careful about if you make a mistake in this. Your financial safety may depend on it. If you're ready to discover the serious side of the 2024 FinCEN filings, stay with us until the end of this video, okay? Now let's get into the video. What's up, team? Welcome back to another episode of the Tax Huddle, where I'll be sharing some financial winning plays to help you beat Uncle Sam on the financial field. Now, in today's episode, we're going to be discussing the mandatory 2024 FinCEN filings for businesses. So let's huddle up and get ready to tackle the details behind these filings. But before we break the huddle, make sure you hit that like button, subscribe to the channel, comment below, and most importantly, pass this video on to your friends, family, and anyone you know who's looking to level up their financial game in 2024. Now, let's break the huddle and dive into everything you need to know about the 2024 FinCEN filings. Ready? Ready. All right, now let's cut to the chase. The 2024 FinCEN filings is not a game, and the penalties for slacking off is no joke. You mess up, you pay up. And we're talking about some serious money here. First off, there are some civil penalties, up to about $500 for every day you're not on the straight and narrow, and it's capped at a whopping $10,000. That's your hard-earned money that's just flying out the window. Now here's where it gets real. There are also some criminal penalties. So picture this, up to 2 years behind bars if you decide to play it fast and loose. Now what's the catch? Providing false or fraudulent beneficial ownership info or failing to keep the FinCEN in the loop. So I'm not sugarcoating here. Take the 2024 FinCEN filing seriously. The consequences are not sweet, okay? So stick around as we break down the details of compliance and keep you in the clear. All right, team, now let's decode the Corporate Transparency Act of 2021, which is the force behind this new 2024 federal filings that's got all the small businesses raising their eyebrows. So what's the deal here? When you as a small business corporation or LLC file with your state secretary, there's an added layer now. You got to file 2 reports simultaneously with the big leagues, the Department of Treasury's Financial Crimes Enforcement Network. It's super long. The Department of the Treasury's Financial Crimes Enforcement Network. There we go. FinCEN for short. Now, report number 1 is the Beneficial Owner Information Report, or as we like to call it, the BOI Report. And then there's report number 2, which is the Company Applicant Information Report. So here's the kicker. These federal filings are entirely separate from your usual state and local filings. So forget about bundling them together. This is a standalone act. From now on, whether you're forming a corporation or an LLC, doing this federal filing is a non-negotiable. It's not a suggestion, it's a new norm. Now let's talk some numbers here. Now brace yourself. FinCEN estimates that a whopping 5 million new small businesses are popping up annually, and each of them is pulled into the realm of CCA compliance. So you see, this isn't just a minor tweak, this is a game changer. So stay tuned for a step-by-step breakdown because trust me, you want to get this right the first time around. Let's dive into the intricacies of the CTA and set you on the path to seamless compliance. Now, step 1 is to determine whether the entity is a reporting company. All right, let's talk about the reporting company business. If the company or the entity that you're working with isn't a reporting company, you can kick back because the CTA is not about to crash your party. But, and there's always a but, most small businesses are reporting companies, unfortunately. The CTA applies to business entities that are formed by filing the documents such as an Articles of Incorporation or an organization with a Secretary of State of Office. This includes LLCs, corporations, limited partnerships, and limited liability partnerships. So let's dive into a little bit more details. So let's think about some sole proprietors. The CTA doesn't apply to sole proprietors because no document needs to be filed to legally establish a sole proprietorship. You simply just start your business on your own. And then we have single member LLCs. The CTA applies to individual business owners who form one member LLCs to operate a business. Even though that single member LLC is taxed as a sole proprietor, which is a disregarded entity, and the reason behind this is you have to file a document. It's typically the Articles of Organization with the Secretary of State to form that one member LLC, just as you would for the multi-member LLC. And then we have rental properties. Many individuals form LLCs to own the rental properties. The newly formed 2024 LLCs trigger the CTA reporting requirements as well. And then we have general partnerships. The CTA does not apply to general partnerships, except in a few states, such as Delaware, where general partnerships must make a state filing and come into existence. In states where the general partnership filing is optional and the partnership makes the filing, it must file the BOI. And then we have business trusts. Now, most business trusts are not reporting companies since no government filings are required to create them, but there are some exceptions, such as the Delaware Statutory Trust. And then we have foreign corporations. The CTA also applies to foreign corporations, LLCs, or all other entities that register to do business in the US. This is typically done by filing a document with the state's Secretary of State. And then we have small businesses. Not all LLCs, corporations, or other business entities are subject to the CTA. Its focus is on smaller businesses that are not already heavily regulated by the federal government. Now, FinCEN did estimate that of the approximate 5.6 million new businesses that are formed each year, about 600,000 of them will be exempt. The broadest exemptions for larger operating companies, and these are businesses with more than 20 full-time employees, those who work more than 30 hours per week. And then they have about $5 million of domestic gross receipts or sales from the prior year tax return. And then they also have a very physical presence in the United States. What's the key thing to note here? Newly formed businesses without a prior year tax return won't qualify for this exemption, but they could become exempt in the future year. In addition to that, the CTA does not apply to publicly traded corporations and other business entities that issue securities registered with the SEC. So that's things like investment funds, investment advisors, registered broker-dealers, banks, registered money transmitting businesses, credit unions, insurance companies, registered public accounting firms, and tax-exempt nonprofits, right, including Section 501c3 corporations and Section 527 public organizations. Now, if a big company like a corporation creates another company that it fully owns, either directly or indirectly, that new company is also exempt. For instance, if a major corporation establishes a subsidiary or a new company that it completely owns, that subsidiary is exempt from the CTA requirement. Now, step 2 is to identify the entity's beneficial owners. Now, the CTA makes businesses reveal and share contact details about their important owners. This information is stored in the FinCEN Beneficial Ownership Secure System, which we call BOS, and that is used by law enforcement, the IRS, and any other government agencies. And one thing to note is, BOS data is not made public. Now, beneficial owners are actual people who own or control a reporting company. Business entities like LLCs or corporations can't be beneficial owners. If a reporting company is owned by a business entity, the human owners of that entity must be listed as a beneficial owner, not the entity itself. There are two kinds of beneficial owners. Number one is humans who own or control at least 25% of the company's ownership interest. And number two is humans who substantially control the company. Ownership interest could be things like an LLC's membership interest or a corporation's share of stock. For simple ownership structures like a 3-member LLC, where each one has 1/3 ownership interest, there are 3 beneficial owners. The same goes for a 4-shareholder corporation where each owner shares about 25% of that corporate stock. Now, for more complex ownership structures, finding that 25% or more owners can be a little bit tricky. All types of ownership interests must be compared with all outstanding interests. Now, the default rule is that any person owning or controlling 25% or more of any ownership interest is a beneficial owner. It can get more complex if individuals don't own 25% or more interest but have substantial control over the company. For instance, if a manager in an LLC has less than 25% ownership, they can still be a beneficial owner if they substantially control that entity. The definition of substantial control is very broad, including senior officers, those who appoint or remove officers or directors, individuals making important decisions, and anyone else with substantial control over the company. For complex structures, reviewing governing documents like bylaws or operating agreements may be necessary. Even informal understandings or relationships could indicate substantial control. When in doubt, it's better to list the person on a BOI report if there's uncertainty about whether they have substantial control or not. Now, there are 5 exemptions. Number 1 is minor children, if their parent or legal guardian is listed. Number 2 is individuals acting on behalf of others, if the person they act for is listed. Number 3 is non-senior officer employees. Number 4 is heirs of company owners, and number 5 is creditors, unless they have substantial control or ownership of 25% or more. Now, step 3 is to obtain beneficial owner information. Once you figure out who the beneficial owners are, you need to gather specific details from them to put into the new business's BOI report. This information includes full legal name, date of birth, complete home address, and a specific identifying number from a current U.S. passport, a state or local ID, driver's license, or if they don't have any of those, a foreign passport. Now, step 4 is identifying company applicants. When you create a reporting company, you also need to mention the company applicants in your BOI report. Now, a company applicant is the person who submitted the formation documents for the reporting company. So, for instance, if you're forming a corporation, it could be the person who filed the articles of incorporation, or for an LLC, the one who submitted the articles of organization. Each reporting company can have a maximum of 2 company applicants. So, for example, we got Jack, we got Cole, and we got Roger. They decide to start up an LLC. They hire XYZ law firm to handle the paperwork, and a paralegal files the articles of organization. In this case, the paralegal and the overseeing attorney become the company applicants. Now, if you use services like LegalZoom to set up your corporation or LLC, it's not clear yet as far as if you have to list the person at LegalZoom who filed your articles. So this is something that FinCEN's going to have to clarify for us. Now, for each company applicant, your BOI report should contain the same details as the beneficial owners, except that you don't need to provide a home address. A business address should be enough. Now, step 5 is to file the BOI report within 90 days. So you need to file the BOI report within 90 days of creating a new business entity, which is essentially 90 days after submitting the formation documents. The online filing is done in the new FinCEN BOSS database starting January 1st of 2024, and it's free. In addition to the details for the beneficial owners and the company applicants, the BOI report must include specific information about the business entity itself. You're going to need the legal name, the address of the main place of business, the state or jurisdiction of where it was formed, and the IRS taxpayer identification number. And step 6 is to file the updated BOI report. For most small businesses, you file the BOI report once, and that's it. Unless there's some changes to the information, there's no need to renew or to update it regularly. If any details in the report change, you just have to file and update a report within 30 days of the change. Now, exempt entities that lose their exempt status must submit a BOI report within 30 days after they are no longer exempt. Make sure your business rules follow the CTA. For businesses with more than one owner, like a multi-member LLC or a corporation with multiple shareholders, it's essential that your official business rules clearly state that all beneficial owners must follow the rules of the CTA. This ensures that everyone is on the same page regarding compliance. So, I know that was a whole lot to unpack, but here's some key things to remember. Number 1, the CTA reporting kicks in for small businesses starting in 2024. Number 2, if your new business formed in 2024 isn't exempt, you must submit a BOI report to the FinCEN within 90 days of its formation. Number 3 is the BOI report to reveal details about all beneficial owners, those humans who either control 25% of the entity's ownership interests or have a significant control. Now, number 4 is that it's very necessary to include names and contact details of company applicants, which are the individual filing formation documents for the entity. And number 5 is the BOI report is submitted online in the FinCEN BOSS database without any filing fees, and it remains valid indefinitely. So remember to update it within 30 days if there are any changes. And there you have it, team, a detailed guide on the new FinCEN filing requirements. If you've enjoyed these tips and want to see some more financial winning plays, please take a moment to hit that like button, subscribe to the Tax Huddle, and pass this video on to your friends, family, and fellow financial players. Until our next huddle, I'm your coach Ibrahim Mohammed. Take care.